What if I told you that gas prices could hit $5 a gallon by the end of this year? Or worse, what if oil prices spike to $200 per barrel, triggering a global economic crisis? This isn't science fiction. This is a real possibility we're facing right now in 2026. Right now, tensions in the Middle East are reaching a boiling point. Iran has openly warned that oil could soar to $200 a barrel. The Strait of Hormuz, a narrow waterway that carries 20% of the world's oil supply, is at risk of being blocked. And here's the kicker. U.S. intervention in oil futures markets, which many see as a solution, could actually make things worse. In the next 16 minutes, I'm going to break down exactly why oil prices could skyrocket faster than anyone expects. We'll explore why U.S. government intervention in oil markets could backfire spectacularly. I'll show you which stocks to watch during this crisis, and I'll reveal why stock options in energy companies like Chevron and Exxon might be the cheapest way to profit from rising oil prices. Whether you're an investor, a concerned citizen, or someone who just wants to understand what's happening to your wallet, this video will give you the complete picture. So let's dive in. Let me start with some historical context. The highest oil price ever recorded was around $147 per barrel back in 2008. When you adjust that for 2026 inflation, it equals roughly $211 per barrel. So a $200 oil scenario isn't unprecedented. We've been there before. More recently, when Russia invaded Ukraine in late February 2022, traders immediately predicted that sanctions would remove 7 million barrels a day from global markets. What happened? Brent crude spiked from $95 to $139 in just weeks. That's a $44 jump in less than a month. Now here's what makes our current situation even more dangerous. We're not just talking about 7 million barrels. If the Strait of Hormuz gets blocked or disrupted, we could lose 14 million barrels per day. That's twice the disruption we saw during the Ukraine crisis. The Strait of Hormuz is the world's most important oil choke point. It's a narrow waterway between Iran and Oman. Every day, about 21 million barrels of oil pass through this strait. That represents roughly 20% of global oil consumption. Think about that for a moment. 1/5 of all oil consumed worldwide flows through this single narrow passage. Iran has made it crystal clear that if U.S. and Israeli strikes continue, they will target energy facilities across the region. The Iranian Revolutionary Guard Corps isn't making empty threats. They have the capability to mine the strait, launch missile attacks on tankers, or use speedboats to harass shipping. Industry experts use the closure of the Strait of Hormuz as their worst-case scenario in thought experiments. It's the nuclear option of oil disruptions. And right now, that nightmare scenario is closer to reality than it's been in decades. So why could oil reach $200 faster than most people think? Let me break down the mechanics. First, oil markets operate on extremely tight margins. Global oil production is roughly 100 million barrels per day. Global consumption is also around 100 million barrels per day. There's very little spare capacity in the system. Saudi Arabia has maybe 2 million barrels per day of spare capacity. That's it. When you remove 14 million barrels per day from this equation, you create an instant shortage of 12 million barrels. That's massive. The market would need to adjust immediately and violently. Second, oil price movements aren't linear. They're exponential during crises. When supply drops by 10%, prices don't just rise by 10%. They can double or triple because buyers panic and start hoarding. Companies rush to secure supply. Countries tap their strategic reserves. Speculators pile into futures contracts. This month alone, oil prices are up 79%. That's on track for the largest monthly gain in the entire history of the oil market, and the Strait of Hormuz isn't even fully blocked yet. Imagine what happens if it actually closes. Third, there's the inflation multiplier effect. When oil prices spike, everything else gets more expensive. Transportation costs rise. Manufacturing costs increase. Food prices jump because farming depends on fuel. Heating and cooling costs soar. This creates a vicious cycle where rising costs feed more inflation. Oxford Economics has identified $140 per barrel as the threshold where the global economy tips into mild recession. At $200 per barrel, we're not talking about mild recession. We're talking about severe economic contraction. Let me put this in terms you can relate to. If oil hits $200 per barrel, gasoline prices in the United States would easily surpass $5 per gallon. In some states, like California, you could see $7 or $8 per gallon. That's not a prediction. That's basic math based on refining margins and distribution costs. Now let's talk about why U.S. intervention could be disastrous. This is where things get really interesting and somewhat controversial. The U.S. government has two main tools to control oil prices. First, they can release oil from the Strategic Petroleum Reserve, or SPR. Second, they can intervene directly in oil futures markets. Both approaches have serious problems. The Strategic Petroleum Reserve currently holds about 370 million barrels. That sounds like a lot until you do the math. U.S. consumption is about 20 million barrels per day, so the entire SPR could supply the U.S. for just 18 days. During the Ukraine crisis, the Biden administration coordinated with the International Energy Agency to release 400 million barrels from global strategic reserves. This was the largest coordinated release in history. And guess what? It barely made a dent. Prices stayed elevated for months. If the Strait of Hormuz closes, we'd lose 14 million barrels per day. Even if we released 1 million barrels per day from the SPR, that replaces only 7% of the lost supply. It's a band-aid on a gunshot wound. But here's where it gets really problematic. The CME Group, which operates the world's largest futures exchange, has warned that U.S. intervention in oil futures markets could be disastrous. When governments intervene in futures markets, they're essentially fighting against market forces. They might impose position limits on speculators. They might manipulate contract settlements. They might even suspend trading during extreme volatility. All of these actions undermine market integrity. When traders lose faith in the fairness and functionality of futures markets, they pull out. Liquidity dries up, price discovery breaks down. And ironically, this can make prices even more volatile, not less. Think about it this way. Futures markets exist to manage risk. Airlines use them to lock in fuel costs. Oil producers use them to guarantee prices for future production. Refiners use them to plan their operations. When you break these markets, you don't eliminate the risk. You just push it underground. There's also a credibility issue. If the U.S. government starts manipulating oil futures, other countries will question the reliability of dollar-denominated commodity markets. This could accelerate the trend toward alternative pricing mechanisms. It could weaken the petrodollar system. The Federal Reserve learned this lesson the hard way during the 1970s. When they tried to control inflation through wage and price controls, it didn't work. It just created shortages and black markets. Eventually, they had to let markets clear at higher prices. The same principle applies to oil. We've covered the trigger and the mechanics. Now we see the danger of the intervention. But what does this mean for your portfolio? That's what we're looking at next. So what happens if we actually hit $200 oil? Let's walk through the economic cascade. First, consumer spending collapses. The average American household spends about $4,000 per year on gasoline at current prices. At $200 oil, that could jump to $8,000 or more. That's an extra $4,000 that can't be spent on restaurants, entertainment, retail, or other discretionary purchases. Second, businesses face margin compression. Companies that rely on transportation like Amazon, FedEx, and UPS see their costs explode. Airlines face bankruptcy risk. Shipping companies struggle. Manufacturing companies that use petroleum products as inputs get squeezed. Third, inflation spirals out of control. If oil hits $200, we could see consumer price inflation hit 12, 13, or even 14%. The Federal Reserve would face an impossible choice. Do they raise interest rates aggressively to fight inflation, which would cause a deep recession, or do they keep rates lower and accept runaway inflation? Some economists are asking how much the U.S. economy would bleed if CPI goes to 12, 13, or 14%. The answer is a lot. Consumer spending would partially collapse. Financial health of businesses would deteriorate, credit markets would seize up, stock markets would crash. But here's what most people miss. The impact isn't uniform. A recession caused by an oil shock hits different sectors very differently. Some industries get crushed, others actually thrive. That brings me to stocks you should be watching during this crisis. I'm going to give you specific names and explain the logic. First, the obvious winners are integrated oil majors. I'm talking about ExxonMobil, Chevron, Shell, BP, and Total Energies. These companies benefit directly from higher oil prices. Their production becomes more valuable. Their existing reserves get marked up, their profits soar. During the 2008 oil spike, ExxonMobil posted record quarterly profits of $14.8 billion. Chevron reported $11.2 billion. If we hit $200 oil, we could see even bigger numbers. But here's the sophisticated play that most retail investors miss. Stock options on these energy giants are incredibly cheap right now. The market has priced in very low volatility expectations. That's a massive opportunity. Let me explain how this works. When you buy a call option on Chevron stock, you're getting leveraged exposure to oil price increases. You control 100 shares of stock for a fraction of the cost. If Chevron stock jumps from $150 to $250 over 6 months, your option could increase fivefold or tenfold. The options market is currently pricing Chevron with an implied volatility of around 25 to 30%. That's historically low for an energy stock. During the Ukraine crisis, implied volatility on energy options spiked above 60%. We could easily see that again. Here's a specific example. You could buy a 6-month call option on Chevron with a strike price 10% above the current stock price for maybe $5 per share. That's $500 per contract. If oil spikes and Chevron stock jumps 30%, that option could be worth $20 or more. That's a 300% return on your option versus a 30% return on the stock. Of course, options involve risk. They can expire worthless if the stock doesn't move enough. But if you believe oil is heading to $200, options give you the most bang for your buck. Beyond the integrated majors, you should watch oil service companies like Schlumberger, Halliburton, and Baker Hughes. When oil prices spike, exploration and production activity increases. These service companies provide the equipment and expertise for drilling. They're a leveraged bet on oil prices. Another sector to watch is tanker companies. If the Strait of Hormuz closes, oil has to travel longer routes around Africa. This increases demand for tankers and drives up shipping rates. Companies like Frontline, Euronav, and Nordic American Tankers could see their day rates double or triple. Don't forget propane and natural gas distributors. When oil spikes, natural gas often follows. Companies like Cheniere Energy, which exports liquefied natural gas, could benefit enormously. Now let's talk about the contrarian view. Not everyone believes $200 oil is inevitable. U.S. Energy Secretary Chris Wright recently said global oil prices hitting $200 per barrel is unlikely. Some market analysts argue that high prices cure high prices. When oil hits $150 or $180, demand destruction kicks in. People drive less. Airlines reduce flights. There's also the question of Iran's credibility. Some analysts think Iran's threats are mostly bluster. Closing the Strait of Hormuz would hurt Iran as much as anyone else. Jim Cramer and other investment strategists have advised people not to panic sell stocks based on oil price fears. Cramer said that talk of oil will be in the news, but it's a bad reason to sell. This is actually smart advice from a tactical perspective. Oil price spikes tend to be sharp but temporary. The market eventually adapts. New supply comes online. Demand adjusts. Prices normalize. The loss of 14 million barrels has to be considered temporary. But here's my take. Even if $200 oil is temporary, the economic damage during that period would be severe. Temporary doesn't mean harmless. Let me bring this all together with some actionable advice. If you're an investor, consider allocating a small portion of your portfolio to energy stocks or energy options. I'm not saying go all in. I'm saying a 5 to 10% position in energy could provide valuable portfolio insurance. If oil spikes, your energy investments offset losses in other sectors. If you're a business owner or manager, start scenario planning now. What happens to your operations if fuel costs double? Can you pass those costs to customers? Do you need to lock in fuel prices through hedging? Can you reduce your dependence on transportation? If you're a regular consumer, think about ways to reduce your gasoline consumption now, before prices spike. Can you carpool, use public transportation, work from home more often, buy a more fuel-efficient vehicle? These adjustments are easier to make before a crisis than during one. For everyone, the key is to stay informed and stay flexible. Oil markets can turn on a dime. What seems impossible today could be reality next month. The bottom line is this. We're facing a perfect storm in oil markets. Geopolitical tensions are at a decade high. Spare production capacity is minimal. Strategic reserves are depleted. And the most important oil choke point in the world is under threat. Can oil hit $200 a barrel? Absolutely. Will U.S. intervention help? Probably not. And it might make things worse by undermining market integrity. The smart money is already positioning for higher oil prices. Energy stocks are attracting institutional buying. Options traders are loading up on calls. Tanker rates are climbing. You don't need to predict the future perfectly. You just need to understand the risks and position yourself accordingly. That's what separating winners from losers in times of crisis is all about. So here's what I want you to do right now. First, subscribe to this channel if you haven't already. We're going to be covering the oil crisis and its economic implications in detail over the coming weeks. You don't want to miss these updates. Second, leave a comment below. Tell me what you think. Are we heading for $200 oil? Are you worried about $5 gasoline? Have you started positioning your portfolio for higher energy prices? I read every comment and I learn from your perspectives. Third, do your own research. Don't take my word for anything. Look at the data, study the history, understand the mechanics of oil markets, make your own informed decisions. The oil crisis is one of the biggest economic stories of 2026. It will impact your wallet, your investments, and your daily life. The people who understand what's happening will be prepared. The people who ignore it will be caught off guard. Knowledge is power. Action is everything. Thanks for watching, and I'll see you in the next video.